Yo, what up, family? How y'all doing today? Today, we're going to go over a little bit of Fibonacci extensions, retracements, and kind of the different ways you can use them as far as using them as your entry point and maybe your exit point, okay? This is something that I've been doing for a long time. I really don't use Fibonacci's too much anymore because I kind of see them already as, as they're there. So let me open up the screen here. As you can see, I have a fib up there right now, but I'm going to kind of just go over um, a little bit of basic stuff as far as fibs real quick. So what I mean by that is Fibonacci is just a point from a start, so the bottom. So this aspect, we're going to be in a bullish to bullish aspects. This is going to be the bullish, and we're going to look for the bearish retracement in order to take the continuation, at least to the previous high here. The reason why I use this for mainly my entry points is because if we look at it this way, like you see the 71 here, let's say that I have, secondary, what's going on here with this? Second. Okay. All right. All right. So if you guys see here, let's say that I have, I want to take my entry point. I'm going to clone here. All right. Go. All right. So for an example, let's say this is the 100% move from the bottom to the top here. Now let's use this as the green. That way we don't confuse. All right. So let's say this is going to be my profit and this is going to be my stop loss. So my loss of a ratio. Okay. So with the 71, you guys understand that this being the whole 100% move from this bottom to this top here, this 71% is going to be the pullback of the entry. So technically, you want to win a better ratio than you're going to lose. So this is bigger than the loss. So you guys probably understand that, okay, being that that's so, we definitely want to have this as a majority for our actual, our account, okay? Because you never want to lose more than you're going to win, because that's going to cause your account to go backwards pretty fast. And what I mean by that is, let's say that I have a bullish candle or a bullish area that big, and then I have a bearish. Say I have a bearish a stop loss. So this is going to be my profit, and then this is going to be my stop loss area, okay? So you see how this is fairly equal. This is gonna be more or less like a 50% or maybe a 61. And what I mean by that is your odds are gonna be different here. So if I take a fib from the bottom to the top here, we're gonna see that where your entry would be here was somewhere close to the 50. So think about it as like, just think about it as 100% and 100 in total, okay? So if you have $100 in your account and you're taking a 50-50 chance, that's possibly losing 50% of your account. Now, theoretically, it's not because you could be doing a lower lot size, so you could only lose $5 on a 0.01. It just depends on what you're using, but as a whole number here, you understand that risking 50-50 of your entry is not going to be as beneficial as risking a 71 profit to a 30% loss or 29. Okay. This is why I use Fibonacci's, because I'd rather have the better entry lower. That way I'm able to have a better percentage of wins, because if I take these here, one second, guys. I'm pulling the wrong thing here. All right, so let me get some so my point in this is if I lose 2 trades, I'm still going to be able to have one good trade that's going to overlap the possibility is if I was doing a 50-50, okay? And by 50-50, obviously I mean like a 50-50 fib. So it'd be half. So if I was to lose one trade here, then if I was to lose 2 trades here, then it'd be equal to, okay? And what I mean by that is obviously you're going to be able to take less amount of trades in order to have a positive or a negative account. So now if I do 3 losses, so even if I take 3 losses of a trade and I still only have one win, I'm still going to be in profit. And this is why I use Fibonacci so heavily, because it allows me to have a better entry of a point. Now, sometimes the entry doesn't always come back to the Fibonacci you want, but in this game, your account is more risk to reward than anything, and that's probably the biggest of importance than anything, because as you see here, you can lose 3 and just win 1, and ultimately your profit's going to be still there. So that's why I choose to take a lower fib as an entry. So that's just the reason of why I use it. So like for an example, if we come down here, I use Fibonacci's from the swing low to the swing high, meaning the last high to the last low. Sometimes I like to take the very, very high depending on what time frame it is. So from here, I'm going to take this top to this bottom here. And you see how we came into the 61. I'm still not interested in that area because I feel like we may have a little bit more here somewhere. Okay. Oops. And ultimately, so ultimately my interest would be up here, okay? For a couple reasons. First reason is going to be to my risk to reward, like we see here. Okay, so if I'm going to sell here, and then my risk is at the top here, then my target is down here, and you kind of see how it's a bigger difference between these two. As far as the risk to reward here is the 2 to 55, so risking 2% and then getting 55 based upon the actual move here. Now, this is why, like I said, I use Fibonacci so correctly, or I use it so consistently. For me, also, this candle frame here, this candlestick, this last bearish to bullish, it's called smart money. So this is also a point of interest for me. If you're interested in smart money, I have a video in my videos. It kind of goes over a little bit about smart money and explain what I mean by this candlestick here. Now, let's take this high to this low here, and we'll see where this wick comes into right here. And you'll kind of see it's probably going to come to like the 71. You see how it comes right into the 71. For me, this reason why this is blue is because 71 for me is my area of entry, or my area of where I'm most confident to take. 78 is still there, but for me, 71 is what I really want to see, because as you see here, these 61s create even tops. So if you're into liquidity or smart money, again, you want to go back and check. Liquidity pretty much is people are selling here and here, thinking that the sell-off move is coming down here now. But ultimately, what they're doing is they're just creating stop losses that people think they're going to sell off already. But what they do is, let's see if I can get this here. So let's say people sold there, looking for their stop loss a little bit higher. Not everyone uses big stop losses. Some people like 10 pip stop losses. And that's funny because that's probably exactly where that's at. But you can kind of see, like, if you're to play this play like this, then ultimately they'd wick your stop loss. And then over here, they tend to move the market this way. And that's why I play this Fibonacci, because more than likely the 61 is going to be like, it's possible for them to move, but more than likely it's kind of a setup for them to really come take the real high of that one. So for another example, we could take the swing low here. So it all depends on how you like to use it and what time frame, okay? Just remember, you can use it from this here to here. So the way I use it is from the structure point of a bullish to a bearish move. So this here was a bearish move. Now this makes a higher high, and you can see how this is going to be the ceiling on top of here. Let me actually get rid of that real quick, guys. Probably look better this way. So let's say this is the ceiling here, and this is the floor here, okay? That it previously bounced off of. So as you see, this is the floor that came to the ceiling. Now, if I draw a fib, more than likely this here is going to be the 78 area. So as you can see here, if I get closer, zoom in, it comes down to the 78 as the retracement. So ultimately, if you guys like retracement, you're going to have an extension, consolidation, retracement, continuation. Okay, extension, consolidation, retracement, continuation. Okay, you see how that works out with this? So it all depends on how you like to use it. There's different methods to use it, but for me, it all depends on the previous move. So for this one here, sorry, this move here is what I'm considering here. Just this move from that last draw down, okay? That last down move, I'm looking this as the retracement. All the rest of this to the right is kind of irrelevant. What I'm just looking at is if this was where price is at currently. Same thing with this one here. I'm looking at where price is at currently from the last bullish move. I'm looking for the retracement from here, possibly to the continuation to the equal highs of here, or to the continuation here. Okay. It doesn't have to come up past this. I guess you would call it like the resistance, the ceiling. Ultimately, it could just continue out this way, like this. So you see this bearish candle here. Most people probably thought like, okay, now it's going to drop and continue bearish here. But they continued the bullish trend here upwards. But like I said, the point for me is to get the entry from the original move, impulsive move, to the retracement, to just um, the actual last high. Now you see here, it does touch the 61, and you can take the 61 up to here. But for me, like I said, for my risk to reward in my account, I'm much more comfortable and much more willing to take the lower advantage from here to here. Let's look for another one here. So we'll take this last area right here from this low to this peak. Now I'm going to look from, like I said, from the move up to the retracement to possibly the equal high to the last move. So being that this here is going to be pretty much the last equal, you see how this comes over here. We're going to take a fib from the bottom to the top. And as we see here, it comes into the 71 to 78, ultimately to continue back to the equal high. And then like at this destination, it decides to come back bearish, okay? But ultimately, you can pretty much count on the original move to come somewhat back into the almost to the peak of the last high. Any further than the last high is ultimately extra money on the table, or extra pips on the table, excuse me. I don't want to use the phrase money. But you understand how this works this way. So now if we use it in a bearish aspect, being from this wick here to this bottom, this probably here is about the same thing as a 70. That's probably a 71, maybe a 78. But my point is that's pretty much my continuation of what I use. So now in a bearish, when you grab this, you're going to start from the top to the bottom. And when you start from a bullish aspect and up, you're going to start from the bottom to the top, okay? So as you can see here, we have this breakdown in bearishness, and then we come back up to the 78, 71 area, and then we continue the bearish trend here, which ultimately comes to the previous low, not the high, because this is the bearish aspect. And so we're right here, they kind of continued back up, but they decided to break a little bit lower. So this would have been extra here from here to here. But as you guys see that, it's pretty, consistent. So now from here to here, you'll notice that most people will play this, which there's nothing wrong with playing this. And this is probably a 61, but this is probably a 71. So we come back to the equal highs again. This is a little bit more risky, but my point is if I would have waited from here to here, I could have caught this almost 61. It's not even a full 61 retracement, but then my win back to the top is a lot less than my loss. So let's say this is gonna be so let's say it's gonna be my win, and then I'll say that this here is gonna be my loss. Sorry, I laughed there because it's just kind of ridiculous. So you see how that's fairly equal. So am I really risking to take the equal trade here from the loss to the win? No, I really don't want that. I'd rather take what it does over here, the 71 over here to the left, to the right. I mean, if we pull it this way, where this one comes into it, where I can continuation back to the top up here. Now my risk to reward becomes a little bit better, and I like my odds a lot more with that move than the other move that was occurred here. Okay, so for me, it's all about risk to reward. If I miss this because it's not at the pullback or the entry that I want, oh well, I'll wait to see if it comes here, and if it doesn't, then from there on, then I kind of have to make my decision. But that's kind of how I use Fibonacci as far as the retracement. Now, what I want to do is I want to do a Fibonacci extension. It's another tool that I learned a while back from my mentor, Abel Melendez, because I could not figure out how to do targets. I didn't know where the heck I was going to do targets, okay, as far as when I should get out. So what I mean by that is, let me find a good example. Kind of have to find a breakout area here. All right, so let's say that my Fibonacci is going to be from here to here. And then as we see right here, my entry point becomes the 71 right here. And then my stop loss is going to be down here, okay? Now, what I do with the extension, so an extension is going to be this one here. Okay, this is Fibonacci extension. So you come over here, trend-based Fibonacci extension. I just call it Fibonacci extension. This is going to kind of tell you where the market might extend to, okay? And it's the same concept. You're going to go from the bottom to the high to the retracement of where the price should enter, okay? Now, as you see here, it has a whole bunch of numbers. I take some of these out. I don't have it set up on this chart, but let me go ahead and kind of set this up so you guys can see. 61, 51. So I don't remember how I set this up on my other one too well, but give me a second. I will use it like that, okay? This is kind of how I have it set up for me, okay? And what this does is the opposite. So it kind of shows you from your entry point to where the next equal highs are going to be. So you see how this Fibonacci extension lines up right where the next equal highs at. And then you'll see there are other ones here that are probably going to be in here somewhere, but I kind of took them off. But ultimately, the first one here is my TP1. My second one here is going to be my TP2. So, what's it mean? All right, so all right, so this is going to be TP1 where the 76 is at. TP2 will be where the 1 evens at. And then TP3 would be up here where the 1.618 is at, okay? This is what I mean by how you use it to look at your extensions where the extended play can go from the original retracement. So break, retracement, and then you have your extension TP1 hit, TP2 hit, and then ultimately it doesn't hit TP3 to about right here or over here. So that's kind of a long trade held, but you can kind of get to how this might help you justify or get an idea of where you should probably take profit, okay? As you also see though that where these are going to be previous areas of where market either rejects or consolidates. So right here, TP2, it consolidates, breaks above it, rejects over here against it again. TP3 rejects in here, it consolidates. You see right here on the bottom here, it kind of consolidates and then breaks below, and it ultimately touches TP1 here. So then it plays between these two, then it breaks up, breaks down, consolidates between them, breaks up, ultimately breaks back into TP3, and then it rejects it again, come back to TP2. So you can see how Fibonacci in general are very, very strong, very, very useful. It's the same thing with the regular Fibonacci. If I take it from here to here, each line that I want to mark up within the fib, you'll see that it's a previous area of rejection or consolidation, or where market might play between it, being the consolidation. Okay, so I can go over here. Okay, so you kind of see how the top part here, this is going to be, these three here are going to be the Fibonacci I drew over there. See how it breaks the top, it rejects, then it breaks through, kind of rejects, breaks up. On a lower time frame, it's going to be a very small consolidation, but it's going to reject ultimately here and then continue. Right here is a very small consolidation on a lower time frame, probably like a 30-minute. But then it breaks through, ultimately comes through, and then you can just kind of see how these play on top of it. And that's kind of like I said, like Fibonacci's are so powerful that it's kind of hard not to use them because they play significant areas or significant structure and resistance points. So you can see here it bounces off, kind of has a bounce here, bounces up, comes over here, bounces, bounce below, bounce up, bounce below, bounce up. So you can see how Fibonacci is based upon swing points from high to lows, depending on where you use them, are going to be very beneficial just to kind of get an idea of like, okay, this point of a fib is going to be my best bet to get out, or maybe my best bet to get in. Also that, okay, at this point of the fib, I might have to look for some consolidation. It doesn't always happen like that, but my point is Fibonacci's are definitely useful, especially risk to reward. And that's the biggest thing for me is I use them risk to reward. And also I've learned to use Fibonacci's are going to be points of whole numbers, institutional numbers, what they call them. So normally like a 20, 50, 80, or 100. Watch. So you see how this one's 151. This one right here is 2080. This one is 360, which is probably going to be closer to um, it's kind of an odd one, but you get my point. Is 60 is a whole number. So you kind of see how these match up with whole numbers, institutional numbers. Also, if you don't know, the markets are ran of algorithmic numbers. So this, in a sense, will tell you algorithmic numbers are normally whole numbers. So as you see what these lines create, they all match up here. So I'll do a video on algorithm numbers also. But as you guys can see, it's very obvious. And once you get to understanding this, trading can kind of become very simple because you understand that you're looking for a certain number of points that match Fibonacci points, that match liquidity points or imbalance points. Liquidity being equal bottoms or bottoms that have yet to be really retraced. So for an example here, this might be an equal bottom area here. And let's see where the bottom of that equal low is at, what the number is. So you see it's 126. So it's not far from 120, 130 as a whole number. And then the bottom of this number here where this wick's at, probably even number 310. Maybe if I move it up, probably 320. So it's right there. So my point is eventually you'll start to understand that numbers is the real game. Fibonacci is part of the real game. Institutional numbers, institutional moves. There's a lot to learn, but once you understand how to put it together, it's very simple. So hope you guys enjoyed. Hope you guys if you guys have any comments, questions, I do have my IG at the beginning of this video. Actually, I'll just drop it right here. This way, if you guys want to definitely maybe have some questions, or you could drop it in the comment. But if if you don't feel comfortable doing that, I completely understand. I can't see it on here. So right here, as you guys can see, I am Sir J Daniel is my Instagram, and then my Facebook, my YouTube, and obviously my YouTube and my Snapchat are all Jonathan Rubio. But if you have any questions and you want to go ahead and take the time to maybe give me a message and ask me like, hey, I didn't understand this, go ahead and shoot me a message. I don't mind at all helping people that are interested in learning a little bit more. So much love. Have a wonderful day, wonderful evening, depending on where you're from, and have a blessed one.